Hi, everyone. Here we are at the final step of our journey, and it's the most crucial one. We have planned, tested, and verified. Now we must conclude and communicate our opinion. This is the auditor's final product, the report.
And that's exactly right. All those weeks of planning, all the testing, all the late nights, it all boils down to this one single formal document. This is where the auditor delivers their professional judgment and really puts their reputation on the line. So here's what we're going to walk through in this final explainer. First, we'll talk about what the report actually is. Then, we're going to break down the 4 possible outcomes, or grades. We'll also touch on a really important special case called going concern. And finally, we'll see what happens even after the report is signed, sealed, and delivered.
Okay, let's get right into it. The absolute best way to think about an audit report, it's like a company's financial report card. It is the auditor's official grade on how well that company has told its financial story for the year.
And look, this is way more than just checking for typos or making sure the numbers add up. The report is an expert's professional opinion on whether the financial statements are a fair and reliable picture of what's really going on in the company. At the end of the day, it's all about building trust.
And since we're calling it a report card, you know what that means? It comes with grades. There are 4 main outcomes an auditor can deliver, and trust me, each one tells a very, very different story to investors and the public.
This right here, this is the question that keeps CFOs and CEOs up at night. After months of scrutiny, what's the verdict going to be? What grade is our company going to get?
So here's the breakdown. At the very top, you've got the A+, the unqualified opinion. That's a clean bill of health. Then there's the B, a qualified opinion, which was basically a mostly good but kind of grade. Then we get into the serious stuff, the F, or an adverse opinion, which signals a huge problem. And finally, the blank paper, a disclaimer, which is when the auditor just can't give a grade at all. Let's dig into each one.
First up, the A+. This is the unqualified opinion, sometimes called a clean opinion. This is the absolute best case scenario, the gold standard. It's the auditor saying, yep, we've checked everything and we've concluded these financial statements give a true and fair view. For any company, this is the holy grail.
Next, let's talk about the B grade, the qualified opinion. This is where the auditor is saying, you know what? Overall, the accounts look fine, except for this one specific issue. That's the key phrase right there, except for. The report is basically saying the financials are fair, except for this one thing over here you need to know about. So why does this happen? Well, it's usually one of 2 things. First, there's a disagreement. Maybe the company didn't set aside enough money for a potential lawsuit. Or, second, there is a scope limitation, meaning the auditor couldn't check something important, like being there for the year-end inventory count. But here's the absolute key. For it to be a B grade, the problem has to be material. It's big enough to matter, but it's not pervasive. It doesn't spoil the whole batch. And this distinction is everything. An isolated, non-pervasive problem is contained. It affects one specific area. That leads to a B grade. But a pervasive problem? Think of that like a drop of ink in a glass of water. It spreads everywhere, it taints the whole thing, and it makes the entire report unreliable. And when that happens, you're looking at much more serious consequences. Which brings us to our first really severe consequence, the F grade, the adverse opinion. This is the worst opinion an auditor can possibly give. It's a direct, unambiguous statement that says, we've looked at everything, and in our professional judgment, these financial statements are fundamentally misleading. Do not trust them. Now, this is rare, but when it happens, it's incredibly serious. It comes from a major disagreement on something that is both material and pervasive. We're talking about things like a massive hidden fraud or a company deliberately ignoring accounting rules in a way that affects the numbers across the board. The auditor is basically setting off a giant red alarm for all investors, and you can bet the company's stock price will feel it.
And finally, we have that blank paper outcome. And it's not an F. It's not even a grade. A disclaimer of opinion is the auditor essentially handing back the test paper and saying, sorry, I couldn't even grade this. They're formally stating that they cannot give an opinion one way or the other. So what triggers this? A massive scope limitation. The auditors were blocked from getting the evidence they needed. And this lack of evidence is so pervasive that they just can't form a conclusion. Imagine key accounting records were never provided, or maybe a fire at a warehouse destroyed all the inventory records right before the count.
The auditor is left shrugging their shoulders, saying, "We just don't have enough information to say if these accounts are fair or not."
Okay, now for a really important and often misunderstood special case. Think of this as the critical fine print on the report card, the issue of going concern.
So what happens if the auditor is looking at the company's situation? Maybe it has massive debts, maybe it's losing money hand over fist, and thinks, there's a real risk this company might not be in business a year from now. What do they do when bankruptcy seems like a real possibility?
Well, this all comes back to a fundamental rule in accounting, the going concern principle. Financial statements are almost always prepared assuming the company will continue to operate for at least the next 12 months. If that assumption is shaky, it changes how you look at everything.
The auditor's process here is so important to understand. If an auditor has serious doubts about the company's future, their first job is to check if the company has been transparent about it. If the company has clearly disclosed all the risks in the notes to its financial statements, the auditor can still issue a clean A+ opinion. But, and this is a big but, they will add a special paragraph in their report that points the reader directly to that disclosure. It's not a bad grade. It's like taking a bright yellow highlighter to a really important risk.
So the report is signed and delivered. The job's done, right? Well, not quite. Now comes what I like to call the parent-teacher conference, where the auditor communicates all their findings in more detail.
The work doesn't just stop. After getting the report out on time, the auditor sits down with management and the audit committee to talk through everything, the key findings, any disagreements, and what needs to be fixed. They'll also provide something called a management letter, which has recommendations for making things better. And especially for internal auditors, the job continues with making sure those changes actually get made.
And with that, we have covered the entire journey. We've gone from planning the audit all the way to delivering the final report. It's graduation day!
Think about it. You now know why audits even exist, how they're planned and carried out, and how all of that work gets boiled down into one final report. Most importantly, you know the crucial difference between a qualified opinion and a disclaimer of opinion. Understanding these outcomes is the key to truly reading a company's financial story. I just want to leave you with this final thought. I really hope this journey has shown you that auditing is so much more than just crunching numbers. It's a profession built on sharp analysis, professional skepticism, and as we've seen today, the power of clear, honest communication. Thanks so much for joining me.